Ever wondered what an ascending triangle pattern is, or how it can be a powerful tool in predicting market trends? Well, sit tight, because in few minutes, we're going to unravel the mystery of this fascinating pattern in the world of trading. Picture this, a triangle, but not just any triangle. This one's special, it's ascending. In trading lingo, an ascending triangle is a bullish chart pattern used to predict the continuation of an existing trend. It's formed by a horizontal line, known as the resistance line, and an upward sloping line, known as the ascending trend line. The resistance line is drawn by connecting the swing highs, which are the highest points reached by the price before it falls back down. On the other hand, the ascending trend line is drawn by connecting the swing lows, which are the lowest points reached by the price before it bounces back up. The point where these two lines meet is called the apex. But how does this pattern come to life? Imagine a tug of war between buyers and sellers. Every time the price dips, buyers step in, pushing the price back up to the resistance line. This tug of war creates higher lows, forming the ascending trend line. Meanwhile, the resistance line remains constant as sellers are strong at this level, preventing the price from breaking through. Now you might be wondering how to trade using an ascending triangle pattern. The answer lies in the breakout. A breakout occurs when the price breaks above the resistance line, usually on high volume. This signals that the buyers have won the tug of war and the price is likely to continue rising. However, it's crucial not to jump the gun. Wait for a candlestick to close above the resistance line to confirm the breakout. Once the breakout is confirmed, it's time to make your move. Enter a long position and place a stop-loss order just below the breakout point to limit potential losses. But remember, trading is not a game of certainty, and the ascending triangle pattern is no exception. Sometimes the price may fake a breakout, only to fall back into the triangle. Or it may break below the ascending trend line, indicating a reversal rather than a continuation. That's why it's essential to use stop-loss orders and other risk management strategies to protect your capital. To sum it up, an ascending triangle pattern is a bullish chart pattern that signals a likely continuation of the current trend. It's formed by a horizontal resistance line and an upward sloping trend line. The key to trading this pattern is to wait for a breakout above the resistance line, then enter a long position and use a stop-loss order to manage risk. Now, armed with this knowledge, you're ready to tackle the world of trading with a new tool in your arsenal. But remember, while the ascending triangle pattern can be a powerful predictor, it's not a guarantee. Always use it in conjunction with other indicators and strategies to increase your chances of success. So, the next time you spot an ascending triangle pattern, you'll know exactly what it means and how to trade it. Happy trading!